Hello, everyone. Thank you for joining us for this webinar on June 30th. I just want to point out that the original title for this presentation a few weeks ago was 2019 Trade War, Trade Resolution, and Interest Rates. And as January progressed, there's been so much going on this month that I chose to expand the title to include possibilities for a lot more issues. So we're calling this now 2019 Threats and Opportunities. So I hope no one's confused, but this is the same webinar that we planned. We've just added more current information, including that the Federal Reserve meeting just ended a few hours ago, and we'll have some comments about that as well. My name is Jim Bell. I'm the founder and chief investment officer here at Bell Investment Advisors. I'm joined today by my colleague, Corinne Salera Bedford, portfolio manager and investment advisor. And Corinne and I have been working together for a few years now on these webinars, and I'm always happy to have your help here, Corinne.
Of course, happy to be here.
This is the overview of what we're going to cover today. So I'll go ahead and let you read these. We're going to start with investor panic as a threat, and we'll end up with U.S. economic strength as an opportunity. So I'm going to ask Corinne under the subject of panic, investor panic, to talk about market volatility and the role it plays in this issue.
Great, thank you, Jim. Yeah, we thought it'd be a good starting point to review last year and the tick up in volatility that we experienced. So towards the right of that graph there, you'll see the words rising rates, trade, peak growth. And then underneath that, it tells you how the S&P 500 declined the last handful of months of the year. Said differently, the S&P 500 declined 19.8% to end the year. And we did see a spike or pickup in volatility based on this index here, which is the Market Volatility Index, or VIX. So even after our December webinar, the last few weeks of the year, the major indices declined and volatility picked up. That said, we think it's important to point out that although, yes, the pickup in volatility put us above the average of this time period from 2006 to 2018, it did not put us at levels seen in the financial crisis. So I'm referring to that box, upper right-hand corner. The average volatility measure is 19.6 across this time period. The latest VIX reading that we saw at the end of 2018 was 25.4, nowhere near what we saw in 2008. Although uncomfortable, we think it was very important to stay invested, and we're going to talk a bit more about the reasons why on the next slide and two.
Thanks, Corinne. So we thought it'd be valuable to point out the market activity. The graph that Corinne just talked about was a visual of changes in volatility. As she said, it was a volatility index. This graph covers the S&P 500 and the Dow Jones daily for a relatively short period of time from beginning of November to up to yesterday, November 29th. I'd like to draw your attention to January 29th, excuse me, to the very low point on this graph, which you can see on the dates below that this was the Christmas Eve dive, so to speak, worst Christmas Eve market action in history. I also want to draw attention to the blue bars on the bottom. These bars measure the volume of trading that has taken place on each of these days as the market has progressed. So as you can see, obviously, in that steep downturn on Christmas Eve, the volume was very high compared to the relative height of the other volumes covered in this period of time. So one important point to know is that whenever there's a steep drop or a big rise in the market or in a stock or in an index, the amount of volume behind it is important. If something dramatic happens, if the market goes down, quite a few points, 2-3% in one day, but the volume's very low, that's less important, or it's discounted on a low volume. There wasn't that many participants in whatever happened. On the other hand, when there's high volume, as we can see, there was around Christmas Eve. I'd call it kind of a capitulation that the panic selling started with the downturn that began in early December, but really picked up pace around Christmas Eve. So that was significant. So getting back to this issue of panic selling, you can imagine that on the right side of the graph, it shows the percentages from the zero line, which is defined as the 65-day moving average for these two indices, the S&P and the Dow Jones. But when the drop got to be below 6, 8, 10% on this graph, you can imagine that the individuals that capitulated to panic selling at those points have missed out on this recovery that started right after the big drop Christmas Eve, and has now taken us up again above the 65-day moving average. So that's a big move, and the reason we emphasize the dangers of panic selling so much is that this is just a good example that investors suffer big losses in opportunity when they don't participate in a 10% recovery from that low point. So there's more narrative to go along with the panic selling phenomenon. In this case, the Investment Company Institute reports that retail investors dumped $44 billion in stock mutual funds and exchange-traded funds during the 3-week plunge at the end of 2018. So that was the graph I just showed you that reached that bottom point at Christmas Eve. And then to put more measurement on this, from that low point in December to yesterday's close on January 29th, the Dow Jones Industrial Average has bounced back 9.6%. So almost a 10% recovery. But if the panic sellers got out and didn't get back in, they've missed all that, and they really won't know when to get back in because there aren't bells that ring when it's optimal to do that. This reflects an old pattern, very consistent behavior, that retail investors sell when they should buy and buy when they should sell. So it's just a repeat example of buying high and selling low. To further this point, a research company, Dalbar, out of Boston, calculates over long periods of time that the average investor in stock mutual fund loses about 2 percentage points a year due to emotional trading. So there's lots of research that shows that mutual fund performance in and of itself always beats what the individual investors are doing because this emotional selling is so common. You probably heard the term market timing, and what we mean by that is a phenomenon that occurs when investors panic and go to cash. And in the 28 years that Bell Investment Advisors has been in business, we've always encouraged our clients to stay committed to and focused on their long-term goals and through market volatilities such as December's slump. So keep the eye on the long term and don't get caught up in the emotional selling activity that comes about through volatility. I'm going to turn this back over to Corinne to start talking about the debt section of our presentation.
Yeah, turning to our next threat, debt. This is a chart that the IMF, or International Monetary Fund, puts out. It is showing the projected change in debt to GDP ratio over the next 5 years across a handful of different economies. What we wanted to point out is we, the US, are just one of 3 countries with a projected increase in this ratio. And when I heard Liz Ann Saunders of Charles Schwab present on this slide, her comment was, this is not a contest that we want to be winning. Another quote that I'd like to share with you comes from Howard Schultz, CEO of Starbucks, who I heard speak to our debt challenges. He was commenting on how much our national debt has skyrocketed, and he said, if we were a company, if America was a company that is at 21.5 trillion of debt, adding 1 trillion a year, we would be facing insolvency. So we certainly think this is a long-term threat that hopefully and should be addressed sooner rather than later. So not only is our debt increasing, but also the interest payments on that debt. With higher interest rates, that means higher interest payments, and that's definitely a headwind for us, a challenge for the United States. On the left here, you see the projected growth in government spending over different areas, including net interest payments. That's the largest green bar there, largest projected growth in government spending over the next 10 years. The next chart shows the net interest payments as a percent of GDP. And you can see the solid blue line is where we actually are, and then the projection given where interest rates are currently. I'm going to turn it back over to Jim to talk about how debt is being addressed in our government currently.
Thank you, Corinne. Some of you in the audience may remember Richard Gephardt. Mr. Gephardt was a member of the House of Representatives for 28 years, from 1977 to 2005. For part of that term, he was the majority leader when the Democrats had the majority in the House. And in that role as majority leader, he had quite a bit of influence and clout. And what I wanted to talk about here is the way the U.S. government handles U.S. government debt is very it's destructive. It's not constructive. So Mr. Gephardt was able to implement a rule called the Gephardt Rule that overcame this danger and silliness of debates and blockages to increase the debt ceiling, something that no other country in the world messes around with, because it is a mess. And it can be very damaging to the U.S. economy and credit rating. So the way the rule works is that whenever Congress adopts a budget resolution or an increase in government spending, it's automatically deemed to have passed a commensurate increase in the debt limit, which was a very efficient and appropriate system, which worked well for several years. What it took, the kind of insanity that it took away, was that when Congress, when different parties in Congress would refuse to increase the debt limit after they've already agreed to spend money, and the analogy here is that Congress can't go out to a fancy restaurant, order a big meal, and enjoy it all, and then refuse to pay for it, which is literally what happens when we have these debt ceiling debates and limits and delays. So this has actually been a serious threat to our economy and our markets when it's been kind of taken to the limit. Unfortunately, the Gephardt rule went away when the Republicans took over the House, and they split up the process being, we agree to spend this money, but in order to do that, we need to raise the debt ceiling that's being tracked. So instead of like the Gephardt rule, where the passage of a new spending bill would automatically raise the debt limit, there wasn't a need for the second vote. Okay, we agree to spend. Now we disagree about paying for it. So the way things are now, there's this politically uncomfortable second vote to raise the debt limit. And not that long ago, this gamemanship caused serious damage in 2011 and 2013, which was accompanied by serious debate by senators and Congress people that maybe we didn't need to honor our debt, or pay off our treasury bonds as they became due. Remarkably destructive thought process. One of the weaknesses to the Gephardt rule, if you will, is that it didn't apply to the Senate. So even if the House of Representatives were able to avoid a debt limit debate and delay, the Senate also independently had to go along with it, which is not guaranteed. I'm pleased to see that Senator Mark Warner has introduced a bill that he calls Stop Stupidity Act, which includes automatic spending authorizations, just like the Gephardt rule, so that Congress pays for what it's already authorized or already ordered and consumed, so to speak. So there's some optimism here that maybe the United States will cease this stupid policy that the rest of the industrial world cannot believe that we do. So I'm going to ask Corinne now to talk about the government shutdown, which was another one of our threats.
Yes, thank you, Jim. So as I'm sure everyone is aware, recently the longest government shutdown in history ended. Began on December 22nd. And of course, this is welcome news for the estimated 800,000 federal workers that were affected. Certainly the impact cannot be overlooked. So we wanted to share some of the most recent stats we've seen about the impact on our economy. The Congressional Budget Office, or CBO, as I will refer to them going forward, estimates the federal government shutdown may have cost the U.S. economy up to $18 billion. This figure includes spending for compensation, the purchases of goods and services, and suspended federal services. Another stat we'd like to share with you: as a result of reduced economic activity, the CBO estimates that real gross domestic product, or GDP, in the fourth quarter of last year was reduced by $3 billion in relation to what it would have been otherwise. 2019, first quarter of 2019, also impacted, and the CBO anticipates that the GDP in this quarter will be reduced by 0.2%. So already in the fourth quarter of last year, in this quarter, we're seeing real impact to our gross domestic product. We also believe there will be, and has been already, a ripple effect flowing to consumers. We've seen weakened consumer sentiment, and of course, that can mean threatened consumer spending, which certainly we don't want to see. We'll discuss later on how important the consumer is to our economy. Finally, delayed data from federal agencies. This is another ripple effect. So there's data that honestly we would likely be presenting today, but that delay from federal agencies is disallowing us to share updated information, and means that economic analysis is being hampered by this delayed data. I'm going to turn it to you, Jim, to discuss our next threat, China.
Thank you. Just before I get into the China issue, I just want to make a more direct connection that the shutdown that we just went through, I think it was 35 days, the longest in U.S. history. There is a linkage there that when the debt ceiling when Congress does not raise it, that's what causes government shutdowns. So the legislation being considered in the Senate and the House would eliminate the possibility that there would ever be another government shutdown, which I think most of us will applaud. So looking at China as a threat, it's obvious, China could certainly also be an opportunity if we could get a real constructive trade agreement with them instead of engaging in this trade war. Just in December, China reported a dramatic drop in exports, and China is very much an export economy. They're transitioning to be a more consumer economy, like the United States, but they need to strike a balance between exports and imports and consumer spending to balance their economy. So this got everyone's attention, the size of this drop. And to expand this issue in terms of China trade, Germany is the most successful European country in terms of exporting cars and other goods to China. And so the German economy and the Chinese economy are very closely wedded, as is true of the United States and China as well. But the German gross domestic product fell to 1.5% for 2018, down from 2.2% in 2017. And a good part of that was caused by the trade friction between China and Germany, and certainly USA and other countries. China is slowing down just as the global economy is slowing down. And on January 16th, China announced a big stimulus package internally of cutting taxes and increasing government spending to give a jolt to their slowing economy. Another positive, if you will, is that the highest trade officer in the Chinese government, Vice Premier Liu, is currently visiting Washington, D.C. and is engaged in trade talks as we speak.
We, of course, encourage these trade talks. We wanted to add this visual to show the impact of not only the tariffs that have been implemented so far, but all that have been proposed, not only on our own GDP, but other countries, China, world GDP, world trade, etc. So what you see here is that all tariffs, those implemented, proposed, would have a drag on US GDP of over 1%. That increases when you look at China's GDP. So very, very important that negotiations are positive, because otherwise the impact would be very widespread. So we think this is a very crucial threat to be addressed if possible.
Thank you, Corinne. So just a few more points to finish up this section about China. China's third quarter gross domestic product slowed to a 6.5% number, and that's the slowest pace of growth since 2009, so kind of a 10-year event, just more evidence of the slowdown in China. A couple of things that China and the United States and many other countries in the world have in common is that the birth rates in many countries are declining. The latest report from China is that they just experienced their lowest birth rate since 1949. Pretty significant trend. The United States shares in this trend, not quite as dramatically as China, but U.S. just reported that it had its fewest newborns since the year 1987. So in both these cases, and in the cases of many other countries, the birth rate is not replacing the population. So if this continues, it will result in a declining population with an aging population that needs a lot of help, and there won't be the people to be there to help them. Of course, a great solution to low birth rates is a robust and effectively vetted immigration policy. I won't say any more about that.
Moving to our last threat, the Federal Reserve. I want to share one data point that the Fed is looking at, the labor market or unemployment data. So this is showing you the unemployed persons versus job openings. Job openings in yellow, unemployed people, the number of unemployed people in blue, showing you that for the first time since these data points were tracked, that there are more job openings than unemployed folks looking for a job, which means the labor market is quite tight and not a lot of room for improvement. So this is one of the data points that the Federal Reserve is looking at. As Jim mentioned, the Fed met today, and there was an announcement that they are not going to hike rates again, at least this time around. So the current federal funds rate range will remain in the range of 2.25 to 2.5%. What was also interesting is that they added a note about the balance sheet and how they plan to be more flexible around the reduction of the balance sheet than otherwise earlier proposed. So we think it's actually very important, this new patient Fed. They, of course, remain very committed to a data-driven approach, but they are forecasting less and planning to respond each and every time they meet to the data that is given to them, and showing more signs of flexibility to economic uncertainties and weakness. So this is actually one category that we believe may has the very good potential of moving from threat to opportunity. They have also adjusted the forecast for this year, given tame inflation and again those economic uncertainties that we've discussed. So it's possible they pause on any further rate hikes until later on this year. Some outside of the Fed, that is, are predicting a cut is possible. So really the path forward is less known than it was last year, but we think that's actually a good thing. They're showing that they are willing and able to be patient and also flexible on the levers that they have at their disposal.
So that completes the issues we wanted to go over in terms of threats. So we're going to transition to opportunities now. The first one being the picture of jobs and inflation. And I'm just going to cut to the chase here and go to the last point on this slide, that in spite of the lowest unemployment in 50 years, inflation in the U.S. has been stable, trending lower. It's very tame. Inflation is not a threat. And that's kind of the American miracle right now, is that we can have such historically low unemployment, and inflation is not a threat to the goodwill and progress of the economy. So that's a very significant point. Also, in terms of corporate earnings, the full calculation hasn't been completed yet, but the fourth quarter that just ended at the end of December 2018, estimates are coming in around 11%. Excuse me. And in comparing 2018 to 2017, the corporate tax cuts provided a dramatic boost to earnings, since corporations got a 14% tax reduction, which added a 14% revenue windfall, if you will. Some claim that the advantage of this tax cut will disappear this year, as we now are going to be comparing 2019 to 2018. I disagree with that. If I were to receive a 14% raise in my salary in 2018, that would set a new base for me, and that 14% increase would persist into 2019, 2020, 2021. So corporations are going to have extra cash flow to work with, and I don't believe the positive effect of that is going to weaken as dramatically as others may project. So, Corinne, another opportunity is U.S. economic strength.
Yes, definitely. We wanted to hone in or reiterate the point we made at our December webinar, that slower growth is still growth. So you see here, we've listed out the gross domestic product figures for Q2, which was 4.2%, 3.5% in the third quarter of last year. And the estimate for fourth quarter is just under 3% at 2.7%. So I'm sure you can notice a pattern of declining GDP, but our point is still slower growth is still growth. One very major positive that we see is that wages are the highest they've been in a decade at 3.2% over the past year. This really bodes well for what folks are taking home, their incomes, and what they are able to do with those incomes. Ideally, they put that back in the economy by spending, as we've discussed a few times over, and I promise to return to this data point, that the consumer spending represents 70% of GDP. So having a strong consumer is and will continue to be very, very important. Real retailers enjoyed their best holiday season in 6 years. Again, that's a very powerful data point in our opinion. And then finally, circling back, as Jim mentioned, or you saw in the chart a few slides before, we've seen solid job growth for the last 99 months, which is a record. So now we're going to move to some of our conclusions for today's webinar.
Thanks, Corinne. So the first conclusion that we listed here is about the panic selling, which I think may be the most important thing that we talked about today, because it affects investor returns more than almost anything else that we deal with. So that willingness to think long term and not panic or control your emotions is a very important characteristic for successful investors.
We want to return to the national debt conversation. As I discussed, national debt is increasing, and also the interest payments on that debt is increasing. And this has the potential to crowd out important government spending that we believe is crucial to the economy.
And the third point is just going back to the damage that the government shutdowns cause, and the insanity of debt ceiling debates, and the hope of legislation that will stop both the debt ceiling damages and the government shutdowns.
On that point as well, we shared this number, but think it's important to share again that the recent government shutdown, the longest in history, is estimated to have cost the U.S. economy as much as $18 billion. And we do fear there will be a ripple effect, and perhaps this will not be the only shutdown that we experience this year. So still a very critical threat in our opinion.
And also, as the global economy is clearly showing down, it's just unfortunate timing that the two largest economies, USA and China, are in a fist fight about their trading relationships. And we sincerely hope that the negotiations that are taking place right now in Washington, D.C., and will continue at least till tomorrow, will produce material progress toward an agreement and turn China away from being a threat to an opportunity.
We also wanted to return to Fed policy and how important we think it is that they're now emphasizing a more patient and flexible approach. We think that this supports better economic growth, and I'll point out too that certainly it appeared the markets enjoyed the announcement today, and as fiduciaries and investors on your behalf, that's very important to us.
And the reality of unemployment being at a historic 50-year low and inflation remaining tame, as I mentioned before, this is an American miracle that we are benefiting from greatly.
The last point and conclusion we wanted to end on is that the benefits to company strength created by the tax cuts will persist into this year, 2019, and following years as well. Perhaps we won't see it reflected in the earnings, the year-over-year earnings results, but we think that the benefits will still attribute to continued company strength, whether that shows up in even higher wage growth figures, capital expenditures, etc. We think the benefits will persist.
Thank you, Corinne, for being my partner in this.
Thank you, Jim.
This concludes what we wanted to share with you. Thank you for your patience. There is a question box on your screen, and if you do have questions that you'd like to submit now, we'll make sure that we get answers for us. On our website at bellinvest.com, we have a whole library of webinars that we've recorded before. This webinar has been recorded and will be available on our website in approximately 1 week. And we'll be doing another investment committee update in the spring, and we will announce the date of that as we get closer to it. We do love to hear from you. There's lots of ways, as you can see on the screen here. So we encourage that. Again, thank you for your attention today, and we'll look forward to presenting to you again for an investment committee update in the springtime. Thank you.
Thank you.